Greetings. Welcome back to another market commentary video for the month of March. Today is March 26th. I've collected some slides going over the recent market action, all sorts of dynamics, soft data, hard data, to help you make sense of this confusing environment. So the title of this is Keep Calm and Carry On. I think that's appropriate given things really aren't that bad when you look at the fundamentals and the hard data and the internals of the market. The soft stuff, the consumer sentiment, all the surveys, there's some confounding things going on where we're actually, sentiment, the way investors feel, is consistent with a crisis market environment. So I've never seen anything like this in my 20 plus years doing this. And as I've titled this, Keep Calm and Carry On, sticking to the long-term investment plan, building a portfolio that reflects the way that you feel about risk wins the day. So let's get into these slides. Per our usual, this is a snapshot of various ETFs, asset classes in which we track and some of our clients invest in. So starting from the bottom and working the way up. A general theme in 2025 thus far is what has been working is no longer working and deeply out of favor. We've been highlighting and talking about this, that given the levels of where U.S. stocks were trading, investors in the S&P, investors in U.S. large cap, investors in big tech would do well to revise their expectations down. In investing, it's seldom that you are correct with timing. Like you can be correct with a theme, but timing is fleeting. So we got a bit lucky with the things that we were saying coming true thus far in 2025. So MAGS is a ETF that represents the big 7 tech stocks, which are heavily exposed to the AI theme. Many of these companies are investing billions upon billions every single year in AI infrastructure. That has been the source of pain. Also, Bitcoin, coming off a really good 2024, has seen some pullback here over the past couple weeks. Certainly not disastrous. 6% being down for Bitcoin is nothing really when you look at the long-term history of that asset class. S&P down about 1.5%. As I alluded to in my blog, if you were to look at the S&P's journey over the past 3 to 6 months, it wouldn't even register, yet people are freaking out like it's 2008. And then real estate, short-term treasuries, intermediate-term treasuries, emerging markets, foreign stocks, and gold, all positive on the year. So again, back to my opening comments, what has been out of favor is working in 2025. What has worked is out of favor, and that's not unusual. Things flip, investors change on a whim, and it's not uncommon for some of these asset classes to move in cycles. A few weeks ago, I pointed out that the tariff narrative out there, that's what's causing the disruption, all this trade uncertainty, and it certainly doesn't help. The question I posed was, a lot of these countries in the tariff crosshairs are having a really good year in 2025. Someone help me unpack that. And it wasn't a conclusion. I just thought that was very interesting that many of these countries that rely on the U.S. to buy their goods, up to 70, 80% of the goods they're exporting, were having amazing years, which brought me back to this really is a story of frothy U.S. large cap stocks fueled by the AI theme really showing cracks. That was the bigger story rather than the tariffs. So if you think about the disease and the symptom, the disease was fully valued U.S. stocks or aggressively overvalued U.S. stocks. AI narrative showing cracks. The symptom or the cause of the sell-off was really the tariff and the headline risk and the politics and all that. So that was what flicked the domino. And it doesn't take much once you're fully valued, overvalued, extreme valued for that trade to unwind. And really that's what we're seeing in 2025. But when you strip out the Mag 7 stocks, when you strip out the S&P, again, many of these asset classes are having a pretty good year. Back to my comments on extreme levels for U.S. large cap stocks. This is a summation of various price to trailing earnings, price to forward earnings, price to trailing sales, various ways to measure how expensive or how cheap a market is. And this is for the S&P 500. So when this line is going up, that's extreme readings, extreme overvalued levels. And you can see, I've highlighted a couple peaks here. And this is kind of nice because it captures like 5 or 6 different metrics, which kind of smooths out the data. But when you go back, current levels, so this is as of last Friday's close. This was at the end of 2021. This was during the tech bubble back in 99 and 2000. U.S. large cap stocks are trading at levels that are consistent with the tech bubble back in 1999 and 2000. And as I alluded to in previous blogs, it's not like an investor can't earn a positive return going forward, but investors would do well to revise their expectations down. And that's something that I still stand behind. Most people tend to overweight what just happened, and what just happened, the S&P 500 has been on a massive run. So a lot of folks have over allocated to that area. And many folks think the investment universe stops at the S&P 500. But as we saw in the previous slides, there's many other asset classes that are more attractively valued, have a better risk return profile going forward than that of mega cap US stocks, which have been on a historical run. So the other part of what we've covered in the past is the sheer concentration of the US large cap stock indexes. So the S&P 500 is 500 of the largest companies in the US. However, it's a market cap weighted index. And what that means is the larger companies explain a great chunk of the S&P's performance. It's very top heavy. These big tech companies are behemoths. And what this captures is when an index becomes concentrated, it becomes a lot more volatile. And that makes sense. When your bets are concentrated in 7 to 10 companies as opposed to an equal weighted index, let's say. So an equal weighted index would be like 100 companies or 500 companies in an ETF or in an index that are all weighted equally. So if you had 100 names in an equal weighted index, each holding would be 1%. So what this captures is the NASDAQ 100, which is a pretty concentrated tech index, and it highlights the 2000 market peak and kind of that journey from 1999 as that froth built up to the peak and then the bubble bursting. I mean, this is a wild ride, up 140% and down 70% or so. This is a wild journey. Take a look at what happened with the equal weight index. So again, this green line is the equal weight index, 500 US companies, all equally weighted. So 500 companies, same percentage across the index. It was a much smoother journey because you didn't have this concentration at the top. To summarize, US large caps are historically expensive. They're very vulnerable because a lot of the S&P 500 is concentrated in 7 to 10 companies. And when you get that, you get a potential for a very volatile ride like we saw back in 2000 and 1999. And I'm not saying this is going to happen again, but when you mix those two components, you get some of these wild swings. And we saw that in 2022. We're seeing it again in 2025. We've been on record saying the AI bet has to pay off. Again, a lot of these companies in the S&P 500, big tech, have invested billions upon billions of dollars in AI. At some point, investors want to see a payoff. So we track how often CFOs and CEOs on earnings calls mention AI. We track AI usage. We track some of the early pioneers like OpenAI, which is still not profitable. And that soft data, when we piece it together, tells us how quickly companies and folks are adopting AI. And you can see these are various industries and sectors, and the light blue is the share of U.S. firms using AI by sector, October 2023. The dark blue is as of March 2025, so you can kind of see the early adopters here in light blue, the more recent adopters in March of 2025, and then plans over the next 6 months for some of these industries to adopt AI. And it's no surprise that tech companies are quick to adopt AI. I mean, they're really the pioneers of what's going on here. And then you can see the various other industries that either have adopted AI or have plans to. And aside from 4 or 5, there's still plenty of industries that have a long way to go as they adopt AI into their business models. Some of it might be cost, some of it might want to be wait and see how it develops, but certainly if AI is going to have a payoff, you would need mass adoption given the sheer dollars that are being invested. So this is something that we'll continue to update and continue to watch. Okay, in my last blog, I highlighted how investor sentiment, some of the soft data is showing folks are feeling about the same as they did in the financial crisis. In the financial crisis, 2008 to 2009, the S&P 500 had a 55% drawdown. I believe as of this recording, today is Wednesday, March 26th, the S&P from peak to trough is down like 6 or 7%, which again is a blip in history. So the market backdrop is not even close to 2008, where banks were failing, people were losing their jobs in droves. There was deflation, so prices were going down. No one was buying anything. It really was a catastrophic environment. Compared to this market environment, and I've tried to capture some of this in the misery index. So the misery index is an index that combines inflation with unemployment. Okay, so the higher those readings, the more miserable people are. The lower the readings, the more miserable conditions are. And I shouldn't say how people are, but what the hard data is saying. So unemployment plus inflation equals the misery index. And again, the higher the reading, the tougher it is out there from an economic standpoint. So you can see, in the 70s and 80s, a lot of this is inflation. So inflation was really high. Unemployment was anywhere from 5 to 7%. This was a painful environment. And then you can see some of these other readings like COVID, unemployment spiked, inflation was going up. Same thing with 2022. A lot of this was inflation. And notice that when the misery reading peaks, especially when you look at recent history, this was almost marking the market bottom. I think the market bottomed October 2022. Again, April 2020, I think the market bottomed in May. So a lot of these misery indexes, when they peak, that's often a good time to get reinvested or to allocate capital. This is where we're currently at, which again, when you look at history, it's not really all that miserable at all. But again, when you talk to people on the street, when you look at the sentiment, the soft data, a lot of people think we're in a crisis market environment. Okay, so here's another hard data point that's not screaming risk off, not screaming recession. This is Dr. Copper. So this is a chart of copper's price going back to 1976. And we haven't talked about this before, but a lot of economists watch the price of copper. And here's a mental shortcut. When the price of copper is going down, it's a cyclical asset. It's an input in manufacturing, infrastructure, construction. When copper is going down, that could signal economic activity is slowing down. When the price of copper is going up, that means economic activity is humming along. And this is as of yesterday, and the price of copper is darn near at a cycle high. So this isn't signaling a slowdown. This is not signaling pain ahead. Of course, this is just one data point, and there could be supply shocks that factor into this. Right now, there's not really a massive supply shock in copper. I mean, inventories are a little shallow, but going back to 2008, I've highlighted a few of these bottoms. You can see this was pretty pronounced during the financial crisis. Not many folks were looking to put shovels into the ground, construction ground to a halt. You can see the bottom in copper. So you'll also notice that when you see bottoms in copper, that's usually a pretty good time to get invested. So 2009, that really marked the bottom in the great financial crisis. 2020 COVID, again in 2022. So you can kind of see some of these sentiment extremes when things are flashing red. That's often a good time to get invested when you get cycle peaks in credit spreads or the VIX or the bottom in copper. And then some of these extremes on the upside can signal, we're getting a little bit stretched and folks are allocating capital a bit recklessly. So there's a theme here. Credit spreads. This is one of our favorite things to track. This is an input to our quantitative process. One of our clients called us Moneyball investors, and I think that's a really good way to summarize our investment approach, meaning we take our cues from the market, data heavy, very quantitative approach, less about what I think, more about what the market is telling us. And right now, credit spreads are not signaling anything. They're still very tight. And for those of you that missed last month's commentary, credit spreads can be a signal of economic stress. So when these lines are going up, that signals a higher borrowing cost environment for lower quality companies. All right. So when the economy slows down, a lot of investors, a lot of capital allocators are less likely to loan money to lower quality companies. And when this line goes up, that's a higher cost of capital for those marginal companies. And it also can signal signs of economic stress. So here's an extreme COVID where these spreads just blew out, and that was a very tough time for companies raising capital. A lot of companies went out of business. But again, when you get these extremes, that can often signal that the worst is behind us. And history has shown investing at these cycle peaks is a pretty good strategy. And fast forward to today, We got a little move up in credit spreads, but again, this blip is really nothing when you look at some of the recent history in credit spreads as well. So again, when we're taking cues from the markets, the headlines don't really equate some of the hard data and what's going on in several of the rules in which we follow. All right, this is the VIX. So the VIX is a measure of how investors think stock prices are going to move over the next 3 to 6 months. And the higher this line goes, the wider the range of outcomes, the wider the uncertainty. So you see a few of these spikes. This is as of the last year or so. So this spike was the yen carry trade back last summer. Most people don't even remember that anymore. You see the latest bout that we got over the tariff trades and all the headline risk. The VIX spiked up. Now the VIX is actually below the long-term average. So the long-term average for the VIX is about 19.5. As of yesterday's close, we're at 17.5. These lines can spike, the volatility, the uncertainty can spike, but very quickly, often they go back down to normal or neutral levels, and in this case, below the historical average. And if you caught our video commentary from last month, when the VIX is below 19.5, the long-term average, forward stock returns tend to be pretty good. When it's above 19.5, forward stock returns tend to be lower or even negative. So this is something that we watch very closely as well. All right, all bears start with a correction, but not all corrections turn into a bear. So we've collected data going back to 1946, I believe, and this is for the S&P 500, capturing how often a correction, which is roughly 10%, turns into a bear market. A bear market is minus 20%. So correction, roughly 10%. How often those 10% corrections turn into a full-on bear, which is negative 20%. So you see the negative 20% line here, and all of the 39 corrections that we've seen since 1946-ish, and how many of those turn into a bear market. And you can see here 13 of the previous 39 corrections turned into a bear market. So that means a third of the time we get more pain, 66% of the time we just resume, and that's the worst of it. So this is where we're currently at, the current correction. And if I was to get this up to date, the market's rallied a bit, so we're probably -6, which wouldn't even qualify for a correction at this point. But you can see 66% of the time, these corrections, which are quite normal, didn't become a bear market. And as you saw last month, the average intra-year correction for the S&P 500, going back about 35 years, is 14%. We have not breached that yet, knock on wood. So this correction is normal when you look at the last 35 years. It's actually below the historical average when you look back at the last 35 years. So again, this headline risk, all the soft data, all the stuff your friends are talking about, what's on social media, doesn't jive with the underlying hard data and the fundamentals. I'm not saying things can't get worse. I'm not saying tariffs are good for the market. I'm saying that current economic data is nowhere near crisis levels. Investor sentiment, consumer sentiment is at crisis levels. I find that gap to be very confounding. So when you look at history, again, this doesn't signal anything imminent. It doesn't signal this is an outlier. It doesn't signal that we're out of the woods either. Certainly, this correction could turn into a bear market. That happens about a third of the time. Again, keep calm and carry on. Build a portfolio that reflects the way you feel about risk. If you're uncomfortable, given what's happened, I think as of this recording, the S&P is down 1%. You really need to look at your risk profile and be honest about your capacity to take risk. Again, the recent market action is really a non-event when you look at market history if you're a student of history. So if you're feeling uncomfortable, really look at your information filters, where you're getting information. I would seek opinions and narratives that challenge your viewpoints. I would go back and look at your position sizing. As I alluded to in last week's blog, many of the prospective client portfolios that we look at are massively overweight big tech, are massively overweight the S&P. That makes sense. That's really worked the last 14 or 15 years. However, what's worked might not work as well over the next 10 years. And I really stick to investors invested in big tech in the S&P 500 would do very well to revise their future expectations down. If you have any questions about how Pure Portfolios manages risk, tracks drawdowns, invests client assets, more into our quantitative rules, feel free to shoot me a note at insight@pureportfolios.com. Thanks for watching. We'll see you next month.